That could easily trip a world war. There's been a lot of war activity happening lately, which, if the US and China get dragged into a war, that's World War III, basically. What if that happened, right? What if, there's all these things that could happen in the economy, right? Like, what if a big bank blows up? What if, all these like possibilities. It's hard to predict what it's going to be, but I can almost guarantee you that something will happen in the next 2 to 5 years. Almost guaranteed, right? I would bet a significant portion of my money on that. And in that event, I would argue that these companies that are listed here with these extremely high price to sales ratios, these are going to be the ones on the chopping block. They're the ones that are going to get hit the hardest. So what if this was a scenario, right? What if we had a strategy that basically didn't lose too much money if Palantir goes up? If Palantir and MicroStrategy and App11, if they keep going up, we're not getting killed, right? We want to have something like that like it doesn't lose a lot of money when things are going up. But if these things drop, and I think if they drop, they're going to drop like rocks. I think Palantir in a bad scenario could go down 50% quite easily in like 2 or 3 weeks span. I think it happened really fast and really hard, right? I want to be positioned where in that sort of scenario, this thing just makes a crap load of money, right? It's just like this big lottery ticket that pays off. That's kind of the thing that I'm looking for personally. So how do we structure that, right? This is what the AI is saying here, right? So it's saying to structure a strategy that captures a massive crash without bleeding out your capital during the melt up phase, I recommend a signal-based barbell strategy. Interesting. This approach keeps the vast majority of your money safe or in the market and only deploys a small sniper allocation of puts when the trend actually breaks. Okay, so recommend structure, the allocation, the sleep well rule. To ensure the account never blows up, you should strictly limit the total risk exposure to the option premium paid. Recommendation, allocate 2 to 5% of your total account value to the put options. The math, if you allocate 5% to puts and they expire worthless, the stock keeps going up, your maximum loss is 5%. You retain 95% of capital. The upside, in a 60% crash, deep out of the money puts can increase in value by 1,000 to 2,000%, 10 to 20x. Wow. 5% position turning into a 10x gain adds 50% to your total portfolio value. Amazing. The timing, don't fight the trend. Since you expect Palantir to keep rising for a few months, buying a put now is dangerous. You will lose money to theta, time decay, every day the crash doesn't happen. The fix, use a trend filter. The bot will only buy puts when the stock shows weakness. Interesting. Buy puts only when price closes below the 50-day moving average. As long as Palantir is above the 50-day line, the uptrend is intact. We sit in cash or hold the stock. The moment it cracks that line, the crash probability increases and we fire that 5% bet. Instrument leverage, strike price, buy puts that are 10 to 15% out of the money. These are cheaper, meaning you can buy more contracts for your 5% allocation. Expiration, buy puts with 3 to 6 months until expiration. This gives the crash time to play out without expiring too quickly. This sounds like a really interesting idea. Okay, this sounds interesting, but what if I have the timing wrong? What if it takes 2 years before it crashes? And what are we doing with our money in the meantime? So what do you think about that? Put it into the comments. Let me know. I respond to all of your comments, so I'm very interested to hear what you thought about the video and what do you want to see next. And of course, if you're interested in any of this stuff, go check it out at botspot.trade.